almost all economists who talk about inflation and interest rates and GDP growth, almost all of them literally work for the government. The, so-called mainstream opinion in that macro economics is going to be pro-government.
What is the job of an economist?
Economics, fundamentally, it's the study of choice. So why do people do things? However, what happens in practice is that the choices that generate profit are the ones where most economists are going to tend to focus.
What you're saying is sort of supporting what I have been believing, is that for the most part, when you hear an economist talking about something, there's more to the story. There is an agenda, or they're being told to say what they're saying.
And ironically, it's worse the more prestigious they are. The so-called top economist in the world is going to be a distinguished, named professor at Harvard. They're making millions of dollars a year. All of it is coming either directly or indirectly through the government. Some of it may come from corporate sponsors who are, again, following the government line. That's a serious social problem because a lot of laws will cite experts and academics. And if the way that you get to the top of the expert totem pole is by following the government line, then the government is sort of selling its own product.
Peter St. Onge, welcome to the Sachs Realty Podcast.
Thanks for having me on, Todd.
I'm really excited. I see a lot of you. I know you have your own YouTube channel, but what really excites me the most is you're not one of the guests that are so well circulated and all of the other YouTubers. And I was just very excited. You are a very smart economist, and I was very excited that you accepted my invite. So thank you for that.
Yeah, of course. Thank you for having me on.
I want to talk about the housing market with you, and to effectively talk about housing, we have to sort of talk about a lot of other things. And one is the overall health of the U.S. economy, the Federal Reserve cutting interest rates, inflation, and ultimately the job market, because I think that as an economist, you understand that without a strong jobs market, there are a lot of industries are in bad shape, and housing really being one of those, because you have to make monthly payments and these costs are at all-time highs. And so, but before we get started, you say, and correct me if I'm wrong, that you're independent politically, and you have your own Substack. Again, all the links for you I will drop in the show notes, and I highly encourage people to check you out, subscribe to your Substack and your YouTube channel, and follow you on X as well. But in your bio, you really piqued my interest. I want to talk about your experience as a young adult. So you had written in one of your Substacks, or I think it's in your bio on your Substack, that you gambled on the .com, when that took off, and you retired at the age of 25 to a remote island, and I think off of Thailand. But you wrote that on one day that you speedboated into inland for provisions, and you walked into an internet cafe and discovered that you had lost all of your money on the .com crash, and then you ended up bartending at a dive bar. So could you just kind of tell us a little bit about that?
Yeah, so let's see. Okay, I grew up in Philadelphia, and I hated Philly. It was a rough place in the 1980s. I had to fight my way through. And so as soon as I could, like pretty much on my 18th birthday, I got the hell out, moved to Japan for a while, then went to Mexico, went to college in Canada. And through all that, I was in my 20s, so I was dating. And from the girlfriends, I learned a bunch of languages. And so that got me, like, by the time I graduated college, I spoke 4 languages. And so that got me a nice job in Mexico and Mexico, Brazil, Argentina. So I was the marketing manager for a big telecoms company, and they needed all 4 languages. So, it was kind of a funny interview. Like, I showed up and I was like, okay, you want a guy in Montreal who speaks Japanese, Spanish, French, and English. We're pretty much done here. When do I start? And then I saw there was an interview with Paul Krugman, and he was talking about the internet, and he said that it wasn't, there's this famous line where he said that the internet would end up having less impact than the fax machine because we would all we would run out of things to say. Which,
Wow.
anybody who's spent more than an hour on social media, you never run out of things to say, right? Like coders have, they have like existential battles over like whether you put two spaces between. I mean, people love to fight over stuff. So anyway, at the time, I thought that was stupid, and I thought, well, Paul Krugman has a high IQ. He's probably smarter than the average person who manages money for a living. And so Paul Krugman's eventually going to realize that the internet is real. It's not just cat pictures. Okay. And all these other guys who manage money are also going to realize that. And there's going to be a flood of money coming to .com. So that was 96 or 97, I think. And so I put my meager life savings into Yahoo, which was the only .com that you could buy at that time. And everybody told me I was an idiot, but I mean, I was like, I was 23, so who cares if you lose all your money, whatever, you'll make it back. Didn't have a family. And so that, of course, took off. So I retired at 25, went backpacking around the world. Again, I was 25 and girls were appealing. So I spent a lot of time chasing that. And then, at some point, I kind of felt like I wasn't doing anything with life, which was true. Also, every time the stocks, they would zigzag a lot, right? They were basically the crypto of the 1990s. So they would triple, they would drop in half. And every time they dropped in half, I would sell out. I'd get nervous, sell out and wait and see. So I went back and I said, okay, wait, if I didn't do that kind of thing, right? If I didn't sell at the lows and then buy back in once it recovered, I would have whatever, $20 million, and then I'd, go and run for Congress. And so I thought, okay, let me stop doing that. I'm going to buy and hold. I'm going to hodl, like they say in Bitcoin. And so, sort of to, like Jason tying himself to the mast in the Argonauts, I said, okay, I'm going to go to some remote island in the middle of nowhere. I'll find something useful to do. So I'll learn Thai kickboxing. And so it was an island called Koh Samet off the coast near Malaysia. And so I went there. I learned kickboxing, which involved kicking trees until your legs bleed. So that was not enjoyable. But anyway, I did that for a while. And then I ran out of cigarettes. And so I came in on the boat to buy some more, and poof, all the money was gone. So I already spoke Japanese. So I moved to Osaka, bartended for a couple of years, and then went to grad school, got the Ph.D. So I laundered my misspent youth, and so now I look legit.
Oh, so you had a typical growing up.
Yeah,
I mean,
yeah, right.
just typical. That's wild, man. Why economics? I mean, you also wrote that as a kid you loved economics. How does a kid love economics? And I mean, could you remember a specific time in your life where you started thinking about maybe it was what something cost or how much a candy bar was? I mean, what intrigued you to go into economics?
Yeah, I was more interested in the social aspect. So, if I put a single question that kind of got me thinking about economics, it was, why do we have so many homeless people? And why did we not used to have homeless people? So as a country, we were much poorer in 1910 than we were when I was growing up in the 70s, right? We're much, much richer, and yet we had homeless people all over. And so I wanted to figure out why that was. We had homeless, like when I walked out of my house, you had to step over homeless. I mean, they were everywhere. Philly was infested with them. And so I wanted to know why that happened. And that took me to Milton Friedman, Free to Choose, and, understanding what kinds of things drive people to homelessness. When I went to college, I actually wanted to study anthropology, but my dad told me he wouldn't pay for it. He was like, okay, if you want to study something like that, you're on your own, kid. And I was living in Montreal, so, I couldn't legally work. And so I was kind of stuck. So I thought, okay, what sounds legit, but is actually, fluffy, like anthropology or history? And there's a field in economics called economic history, where, you go back and look at like pig iron production in Belgium in 1500 or something. But in that field, you also look at things like, why was Song Dynasty China rich? Why did the currency collapse and then the Mongols invaded? So you can do a lot of things that fundamentally, really, they're anthropology or even history. And so that that passed the dad test, and he opened his wallet for economics. And then once once I was at the bartender thing, I actually got a grown-up job at that point. I moved to New York and I worked for a big Japanese toy company, Takara, which makes the Transformers. Hasbro licenses them, but Takara makes them. So I was working there. Kind of like marketing is actually interesting because there's a lot of psychology to it, right? And unlike the official field of psychology, marketing actually works. There's a feedback mechanism, right? Bullshit walks. And so I think that the psychological models in marketing, which fundamentally is about how do you get somebody to do something, right? And, economics is a lot of that as well. So in economics, you're looking at the world and you're saying, okay, people are doing these bad things, things that are self-destructive or things that don't, create prosperity, crime, for example. So how do we encourage people to do less of that? So there's a lot of overlap between all these. That was fun at a toy company because what you're doing in toy marketing is that you're aiming at the kids, you're also aiming at the parents, and you're aiming at the grandparents. And kids are like separate human beings, right? So between 0 and 3 years old versus between like 12 and 14, they are literally different species. You're not even talking different countries. These are different, So it's fun because you've got all these mental models. So people at different ages, including parents and grandparents, they want different things in life. Right. For example, young kids want to be Superman because Superman is good. He is pure. He's good. He is skilled at everything he attempts. He has no dark history. Right. On the other hand, once they get to 12 or 14, they want to be Batman because Batman's edgy. Right. Batman's kind of got like a rebellious streak. And so this reflects what children's goal in life is, right? When you're really young, you want to appear competent so that the parents feed you when the hungry times come. When you're 12 or 14, at that point, you're going to survive because the parents are going to feed you preferentially over the younger kids. They're going to let the younger kids starve. By the way, that is research. So once you're 14, you're out of the woods. They're going to keep you alive. And so at that point, you start to sort of socially differentiate yourself, to start building sort of social capital among your peers so that you can eventually reproduce. So anyway, it was fascinating to do that for a couple of years, but it reminded me that, rather than doing sales calls, sitting down with like Bed Bath and Beyond to place robot octopuses, like that wasn't really what I wanted to do in life. I was really a lot more interested in the analytical side. And so at that point went back for the Ph.D., went out. I taught for about 5 years in Taiwan, in an MBA program. I actually wanted to teach in the US because the money's much better, but of course there's ideological discrimination. And so, if you're a libertarian or Austrian school, realistically, you can only teach at a Christian school. They want a statement of faith. I'm not religious. I'm not going to fake it. So that took me to Taiwan. Taiwan was fascinating because culturally, Taiwan is like a natural experiment. What if you took China, but you didn't make it communist? Right? What would the people be like? What would the economy be like? And I got to tell you, Taiwanese are they're really, really wonderful people. I joke if Japan and Mexico had a baby, it would be Taiwan, meaning that it would also be China, right? Wonderful people, warm, really hardworking, honest. If they tell you that they'll do something, they'll do it. Even more proactive than Americans. Americans are much more proactive than Europeans, for example. Right, Americans are pretty high on that chart. Americans get stuff done. We're bold. We're energetic. We're creative. But Taiwanese are just absolutely off the chart. So that was fun. We were there for about 5 years. I kind of felt like I wasn't contributing anything to the world beyond my students, and so came back to the U.S. Started making these daily videos on economics and freedom. The videos are actually what I used to do before class. So if you're teaching an MBA program, I was the white guy, and so I was like the bottom of the totem pole, right? Because everybody else is permanent in the university, so they're all doing favors for each other, but I'm the outsider. So they gave me all the crap classes. So like I had to teach statistics at 9 a.m. on a Friday, which, if you know anything about MBA students, they are all hungover, the ones who are there. And so the trick was to make the class interesting. And so I would have these little shticks in the beginning of class, just talking about what's going on in the news. So why does strategic marketing matter? Because this company did that, and then they lost market share. And so I essentially just do the exact same thing now, but I do it for mostly macro topics, so inflation, growth, things like that. every morning, and they're really short. They're 3.5 minutes, so that people don't get bored.
It sounds very interesting, and I'm sure because you did so much traveling around the world, it was an easy thing for you to do, to go teach outside of the U.S. But let's kind of boil down, what is an economist? People hear this economist says this and believes that, and what is the job of an economist? And I guess also, in your opinion, how has the role of an economist changed over the last 100 years?
Yeah, so there are a lot of fields where, here, let's take art for an example. So, what is an artist? In theory, an artist is somebody who comes up with creative and original, expressions of beauty or meaning or whatever. But in reality, an artist is somebody who does whatever the client says, right? So, if you actually intend to keep, body and soul together as an artist, you have to seek out, you have to ask, what does the market want? And maybe the market wants, graffiti written on hats. Is that art? It's a way to stay alive. And so in economics, it's similar, where as a field, economics, fundamentally, it's the study of choice. So why do people do things? Why do they commit crime? Why do they have families? Why do they get a job? Why do they buy a house? Whatever. However, what happens in practice is that the choices that generate profit are the ones where, most economists are going to tend to focus, right? So, for example, if you take housing, there's a lot of housing economists. There are relatively few crime economists. Why? Because crime pays the criminal, but housing pays the person who's actually paying you to do the research. And so, depending on which we look at, but if we sort of boil away from, and I mean, in fact, most economists work for the government, either directly, like almost all economists who talk about inflation and interest rates and GDP growth, almost all of them literally work for the government. And so the so-called mainstream opinion in that macro economics is going to be pro-government. The ones who are left overwhelmingly work indirectly for government. So they work at universities that are government funded. They get promoted if they bring in government grants. How do you bring in a government grant? You say exactly what the government wants you to say, because you're no dummy. So in practice, the field is sort of captured day to day. So somebody like Paul Krugman is sort of an excellent example of this. He's pro-government in everything he does. Why? Because that's who pays the bills. But if we boil out economics himself, and we sort of strip government out of it, then economics it's not necessarily that interested in like GDP or inflation. It's a lot more interested fundamentally in choice. And there's a branch of economics that continues that sort of theoretical focus, which is Austrian economics. So it's why in Austrian economics, or why I'm an Austrian economist. And Austrian, it's kind of interesting how it gets its name. So in the 1800s, the field of economics was dominated by German speakers. And there were two big German countries, which were Prussia or Germany and Austria. And the Prussian model was that the government proactively took over the civil sector. So it would basically do what we do today in the U.S. with like U.S. aid and all this government corruption. It was paying pretty much everybody, but it was paying academics to become what Rothbard called intellectual bodyguards of the regime. Okay, and so the Prussian universities were tools of government control. Austria did not do that. Austria was a much more decentralized country. It was not so totalitarian. It was a monarchy. And in the Austrian model, the universities got their money from tuition. They didn't get it from government. And so in Austria, they were teaching that sort of classical economics, to try to understand how the world works. Whereas in Prussia, they were trying to promote government policies. So even today, so-called mainstream economics is just that Prussian legacy. Okay, the vast majority, 90% of economists are effectively those Prussians. They're the ones who are doing it. They're singing for their supper. They're the artists who are, paid on, they're making junk they don't believe in for commissions. Now, most of them do believe in it, but that's because they're paid to. It's a lot easier to prostitute yourself when you actually believe it. And then the very small minority of economists are the Austrians. We're the ones who look at the field without the government corruption in it. And when you strip the government corruption out of it, the field itself, if you're studying choice, you're asking, how do people become happy? And in that, almost always, the conclusion is government needs to get out of the way.
I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show.
Right. So, for example, how can people pick the right spouse? Well, you certainly don't want a government department, right? If you're thinking about marrying somebody, you don't want a list of regulations that you have to follow. Is your age within this range? Is your intelligence level? Is your sense of humor? Here's a test. You don't want that, right? You need a free market marriage. Are people going to make mistakes? Absolutely. They're going to marry because of other factors. But the way that you're going to maximize people's happiness is that you have a free market marriage. Similarly, across the entire economy. So, you don't want restrictions on what kind of jobs people can do, licensing requirements. You want disclosure. You want customers to understand if you're actually a doctor or if you bought it out of a Cracker Jack box. But fundamentally, the conclusions in that sort of pure economics are almost always small government. That's part of the reason why governments capture them in the first place, is to try to propagandize.
Interesting. What you're saying, and as I'm listening to you, I'm glad you said what you said, because as a real estate broker and someone that has been in the housing market for a long time, I see a lot of economists talk about things that really don't make a lot of sense. And I sit there and I'm like, they can't believe. Maybe they're believing it by design, but it's almost like they're just putting things out there to convince people, because most people don't look back through the layers. They don't educate themselves a lot. They just listen to what they hear on mainstream media, and they think that that's the truth or it's the gospel. This economist says this, or this economist believes that. And but what you're saying is sort of supporting what I have been believing, is that for the most part, when you hear an economist talking about something, there's more to the story. There is an agenda, or there is some type of intention. They're being told to say what they're saying, and that's what you're saying.
And ironically, it's worse the more prestigious they are, right? So the so-called top economist in the world is going to be a distinguished, named professor at Harvard. They are completely captured. They're making millions of dollars a year. All of it is coming either directly or indirectly through the government. Some of it may come from corporate sponsors who are, again, following the government line. And, that's a serious social problem, because a lot of laws will cite experts and academics. And if the way that you get to the top of the expert totem pole is by following the government line, then what you're effectively getting is, the government is sort of selling its own product. We've seen that in spades, where you've got a lot of research that's very motivated in one direction. And why? Because the government itself has an opinion. Now, what's the government opinion? This is what people call the deep state. There's a permanent bureaucracy that was created starting in the late 1800s, the Pendleton Act. The reason for and it was created intentionally to be insulated from politics, meaning it's insulated from voters, meaning who controls it? It controls itself. Right. So the Pendleton Act effectively gave us a country where there's this permanent government class that runs the country. And then you've just got this decoration laid over top of it, which is the politicians. But that permanent class, bureaucratic class, the deep state, that, because it funds money to universities, and then it uses those universities' so-called studies to promote whatever it wants. So, the rest of us are left with either just throwing out anything that anybody from Harvard says, or, you have to kind of dig in and try to figure out, essentially figure out what's the government point of view, what's this guy's point of view. If it's the same point of view, then I'm probably going to throw it out. This is not just in the sort of soft sciences like economics or psychology. This is even in the hard sciences. So there was a study, Bayer, the German pharmaceutical and chemical company, they were looking at cancer treatments. And before they started, looking for targets, they went through the existing academic research and they went back and tested them all. They just wanted to make sure that they could replicate the results. And it's from memory, but something like 2/3 of the results could not be replicated, which is pretty shocking. Okay, that's completely top end, Oxford, Harvard, MIT, top studies on oncology. 2/3 could not be reproduced. Bayer knows what they're doing. They've got a lot of resources. They were unable to reproduce them. If you can't reproduce a study, the original study is garbage. Garbage or fraud, depending on what the motivation was. That is oncology. Okay, so what percent of psychology or, gender or economics, right? These are all much softer fields. It's much easier to play with these statistics. What percent of those are garbage? Roughly all of them.
Wow. There are several different avenues that an economist can take. Obviously, they can focus on the more macro, the more microeconomic side of things, or financial statement analysis. And I mean, obviously, a lot of this goes into lobbying too, right? So a lot of economists take the lobbying route. Can you just kind of define each one of those? I mean, and well, we'll just start with that.
Yeah, the two big fields in economics are macro and micro. Macro meaning big. Macro is what most people think about the economy. So that's inflation, GDP, jobs, interest rates. Micro, you can almost think of it as business economics. So it's the kind of topics that you would care about in a business. So things like your accounting, your marketing, your strategy, your production, your supply chain, your relationships with suppliers and employees and customers, marketing. So all those things figure into micro. My base is actually micro. Like what I was teaching over in Taiwan was generally business. So I was teaching people how to compete with American. I would have been happy to teach Americans, but anyway, there we are. In terms of corruption, macro is much worse. Because that's one that's much more useful to governments. Governments don't care that much about things like marketing. I mean, they stick their nose in on DEI, corporate social responsibility, things like that. But at core, they don't care that much about corporate strategy or accounting. They tend to care a lot more about those big picture things. And the reason they care about the big picture things is that, number one, they're graded based on that. So, for instance, in the last election, one of the two biggest issues were immigration and inflation, right? So governments have a very deep interest in cooking the books on inflation or on trying to fix inflation when they break it. That tends to be the one that's a lot more screwed up. So-called Keynesian economics, which is really just pro-government economics. It's been around long before Keynes. As a sort of crank science. And Keynesian almost exclusively focuses on macro. They really don't have much opinions on micro. So micro is a lot purer. Anybody who has studied economics who does not know Austrian economics, in a nutshell, Austrian is going to be micro. Okay, so you just take micro, that business economics, which is essentially, good economics. You apply that to the entire economy. The Keynesian garbage economics, that's so-called macro.
Gotcha. And how, when did it start that I guess, was it the government that sort of painted the bad picture of Austrian economics? Is that sort of because it was more free market? I mean, what is that why?
Yeah, so to give an illustration, so the break happened in the early 1930s, and the bad guys used John Maynard Keynes, who he's a famous so-called economist. He's not actually an economist. He wasn't trained in economics. He was a pedophile, incidentally. He was well known. Pretty much a crap guy. But anyway, they used him because he was a smooth talker. So they used him to mount sort of a government takeover of economics in the 1930s. And so when you look in, up until the 1920s, economics was basically Austrian. It was free market, small government. The general recommendation was government should get out. There's a famous line, economics is the dismal science, where there was some government bureaucrat that complained that every great idea the government had, the economist said, no, it's not going to work because it's going to backfire and it's going to do all these other problems. And so he said, you guys are miserable. You don't have any creativity. You're just negative nannies, Nellies. And in the 1930s, that flipped, where government dumped boatloads of money into economics, essentially took over the field. So what kind of world did that give us? Well, if you look at we can look at recessions because those are kind of the moment when governments are most liable to screw things up. So the last recession we had before that takeover in the U.S. was in 1919, right after World War I. And that was called the Forgotten Depression in a great book by James Grant. But anyway, what happened there was that we were demobilizing after World War I. So we were turning all the guns into butter. And when you do that, you have this big dip in economic activity because you have all these factories that are useless now, right? They have to be shut down. They have to be changed over to produce something new. And during that recession, so it was a very deep recession. It was actually worse than the beginning of the Great Depression. And what happened during that is that the president was sick, President Wilson. And his wife wasn't really confident about making big decisions. And so she just kind of didn't do anything. She just said, no, let's just wait until Woodrow is feeling better. And so the government, bizarrely, did nothing. And what happened is that we had a real sharp depression, and then we had just an absolutely epic rebound, better than ever. And in fact, that gave us a decade of prosperity, which we call the Roaring Twenties. So 1919. Next up, now the government, you have the government takeover. You had specifically FDR, who had a bunch of these sort of pro-government economists on his so-called brain trust. So you fast forward now to 1929, and you actually had something that was not nearly as bad as the demobilization. You just had a stock market crash. Stock markets crash all the time. Who cares? You don't do a thing about it. In 1987, during Ronald Reagan, we had a single-day crash of, I think, 20%. We didn't do anything. Nothing happened. We didn't have a recession. We didn't have anything. That was actually worse than 1929. So in 1929, yeah, stock market crash. That was the opportunity that these bad guys were looking for. These pro-government economists, they'd actually infiltrated both parties at that point. So Hoover was, in modern terms, he was essentially a communist. He and FDR had the exact same policy mix. So Hoover, rather than just letting people go bankrupt. I mean, if you gamble, you lose. Suck it up. That's the free market. Instead of doing that, they jumped in. They put wage freezes. Prices generally decline in a recession because debts default. Okay, and every debt is sort of functioning as kind of money, and so if it defaults, and you effectively remove the amount of money, so you always have deflation during recessions. So you had this massive deflation starting in 1929. Prices fell by like half. But the Washington put this pressure on companies to not change wages. So what that means is that you have this crash, and you effectively have to pay people twice as much, right? Because deflation, was massive, but you're going to get in trouble. Your regulators are going to explore your licenses, or they're going to come. The kind of thing that happened to Elon Musk in the past couple of years, where these regulators just harass you. And so rather than 1919, where you had a big crash and then a big rebound, it stayed low. And then the banks started failing, and again the government came in and screwed that up. They actually broke the U.S. dollar. That was really our first national default of the 20th century anyway. And FDR just kept doing this. And so rather than, 1929 should have been nothing. It was a stock crash. Who cares? A couple of people would have jumped out windows, and that's that. It was not even as bad as 1919. But instead of being like a 12 or 18-month recession like 1919, instead of that, we got 7 years. I mean, it was just endless, because FDR had these pro-government guys, and every time they would turn around, they would put some new rule in. So you had what's effectively a capital strike. Companies stopped building factories. The income tax rate went to 92%. I personally would not wake up in the morning at 92%, right? Why bother? I would sit back and wait until FDR gets out of office and buy a boat. You're not going to build a factory with your millions if you're getting taxed 92%, because there's risk, right? The factory might not work out, and the government's not going to give you 92% of your losses, right? It's an asymmetric payoff. At that point, you're just going to buy a boat. Screw it. Go off to Europe, collect art, which is exactly what people were doing in the 1930s. Guys like J.P. Morgan, they were running around Italy buying art. This is a 92% tax rate. Why bother? So the entire economy crawled to a halt. The only thing that bailed it out was that once FDR decided that he wanted to get into World War II, wanted to get the Japanese to bomb us, once he made that decision, that point, they knew that the only way that America was going to be able to fight that war was if they quit crushing companies. So then they sat down with companies. Okay, what do you guys need? What kind of regulations can we get rid of? What kind of tax breaks do you need? And then at that point, the recession finally ended. So that's a sort of a snapshot of what it looked like in the sort of free market Austrian classical economics world, which is where the economy does amazing, but government does not get bigger, right? Versus the 1930 world where the people, I mean, it was miserable, right? People were starving, but the government grew in leaps and bounds. Like the entire deep state that we talk about today, almost the entire thing was created in the 1930s. So the people were crushed, but the government feasted. So that's the difference between that shift in economics.
Yeah. Let's talk about where we are right now, and we'll start it off with interest rates. I've heard you say in one of your podcasts that things are really going to break when the Fed starts to drop rates again. Obviously, there's a whole lot with the Federal Reserve, and since they were created, and how when you talk about the recessions were almost like a corrective mechanism that happened on its own. And if you go back 200 years, certainly recessions were part of it. They called them panics, depressions, pandemics. I mean, there's all kinds of things, but they were very short-lived. They happened every 2 to 5 years. It was a very quick correction, and then things were booming again. And we've seemed to have this mechanism, you're saying created in the 30s, and the Federal Reserve in a lot of ways has a lot to do with this. And I don't think people really understand when they hear Chairman Powell or President Trump saying, or his administration saying that we need to drop rates, that Powell needs to have pressure on to drop the rates. And I don't think people really understand what that is and what those interest rates really are. But it seems like since we've learned, and I don't say we as in me and you, but since they have learned that they can manipulate these rates and sort of create recessions or prevent recessions or prolong recessions, it seems like, and then when we watched what happened in the GFC was our really first, in my opinion, the first evidence of this manipulation finally imploding since World War II. Can you just tell everybody, what is the Fed rate, what that means, and how it's so important to realize what they do with this rate and how it affects consumers?
Yeah, so the interest rate is the main way that the Fed can manipulate the economy. And the way it works is that the Fed sets the interest rate like 5%, and then every other interest rate in the economy follows off that, right? So mortgages are typically going to be, something like 2% higher than that. Corporate borrowing might be 1% if it's a big company, or 5% higher than that. All right, so whatever the Fed sets that rate at, it ripples through all the borrowing in the economy. The reason that matters is because if you make that rate really low, then money's really cheap. And so companies will borrow more, they'll build more factories, they'll hire more people. Consumers will borrow more, they'll use more credit cards, they'll use buy now, pay later, right? They'll buy cars, they'll buy bigger houses if mortgages are cheaper. So that means that the Fed can basically create a tissue fire at will. Okay, it can create this tissue fire economy. It burns real bright, but burns real fast. The reason it burns real fast is that if you lower rates, that is going to cause inflation, because all that borrowing is going to increase the amount of money in the economy, because most money is not actually created by the Fed, it's created by banks. It's like when you go to the bank, if you want to borrow a house, for example, let's say that you go to JP Morgan, and you want to borrow for a house loan, but they're not your bank. Well, they'll tell you you have to create an account there first. So why? Right? No, I just want to borrow money. I don't want an account at your bank. Well, the reason is because they literally create it. Okay. And so the vast and they create it because then they use that loan as collateral for the loan or for the money that they gave you. Right. So the result is that if you pull the interest rate down enough, the banks, they start just pumping out money. So that raises inflation. Now, once you raise inflation, well, the way that you have to counter that is that now you have to raise rates beyond what they should be. Because if you just return them to normal, which is something like 3% after inflation, if you just return them to normal, you're not actually going to end the inflation, right? In order to end it, you have to crank them up. And so it's the opposite of the tissue fire. Now you're sort of intentionally strangling the economy to try to get that loan creation down so that you don't have as much money chasing goods. So the Fed has this sort of boom bust pattern where it instinctively is trying to push rates low all the time. That's the reason why central banks are created, because they're inflation machines. And, Wall Street can profit off that. So they sort of by nature try to push interest rates too low. And then every time that inflation takes off, they then crank them up too high. If you look at the recessions, every single recession since the Fed was created, you can look at the interest rate and they hike the interest rate, boom, we get a recession. Hike the interest rate, boom, get a recession. Every time they drag it down, in recent recessions, they drag it down to basically zero. And then you get the inflation, and then they crank it up again. So we saw this exact process play out during Joe Biden, where because of COVID, they yanked rates down to nearly zero. Of course, inflation was, I think it was 2 or 3% at that point. So, literally you were getting paid to borrow money. Or if you can borrow money at 0% and inflation is 2-3, then the inflation is literally melting away the loan. There was a point even in housing, right? So in, what was it? 21, I think, you had mortgage rates at one point they were 2.7%. And that was during Bidenflation. So Bidenflation was like 7% official, probably 9% real. So you were literally getting paid 6%. You were getting paid to borrow money, right? And, that does a couple things, right? One of them is that, of course, it created the inflation. The other thing is that it is this wholesale transfer of assets from the poor and the working class to the rich, right? Overwhelmingly, people who borrow money are rich people because they have collateral. Right? Like your average, blue collar worker cannot take on $1 million loan. If you're out in Malibu, everybody's got $1 million loans. So rich people borrow at something like 8 times more than middle class, which means that if you are making borrowing cheap, if you are pushing interest rates down to the point that you're getting paid to borrow, that money is overwhelmingly going to the rich. So we saw that during COVID. So before COVID, 2019, billionaires owned about 14% of the wealth in the country. After COVID, 21%. That is a massive change. It took decades to get to 14. And then, boom, 50% in 5 years. So, and, of course, the so-called free market catches the blame for this. It's law of the jungle, oligarchy. No, it's the Federal Reserve. It's the Federal Reserve with an assist from government corruption, where they give all these special rules to big businesses, regulation to try to crush the competition. But yeah, that's fundamentally what the Fed does, is it leaves us with the so-called business cycle, which is it's not the business cycle, it's the Federal Reserve cycle. Lowers rates to get the boom, raises rates to get the boom and the inflation, raises rates to get the recession, and then you get this almost clockwork boom, bust, boom, bust. And, you've got a whole industry that, tries to identify why are companies so optimistic? Why are they now pessimistic? No, it's the Federal Reserve. They screwed the interest rates again.
Yeah, because deflation doesn't really work in the United States. We can't, especially when you're talking about assets like housing. If we get deflation in housing, which needs to happen for affordability to return, but that really breaks the system even more, because people owe money on these houses. And
well, and houses make up 2/3 of Americans' retirement savings. Two-thirds of their net worth. So functionally, Americans are using the home equity as their IRA or 401k. So if housing collapses, they don't have anything left for retirement.
How has the Fed, do you believe they've kind of boxed themselves in this time? Because people can't afford to live now. Inflation is very sticky, especially shelter inflation, housing, home-related services, housing-related services. the grocery store. I mean, it just, I could go on and on. It seems like gas prices have come down a little, but where's the Fed now in where if they drop rates, and will we see more inflation? Because right now people can't afford to live without debt.
Right. Yeah, so inflation is actually improving. Since Trump took office, it's been averaging about 1.2% annualized. So inflation is doing great. I think, though, that you're right that the Fed is painted into a corner, and where they're painted is that they held rates so low for so long that really jacked up asset prices. So housing, stock markets, gold, Bitcoin, but also housing. So a lot of where we are on house prices right now is because of the near zero interest rates that we've had really since the 2008 financial crisis, even for a good chunk before that, since the year 2000. And we're seeing this now in Japan, where Japan had essentially zero interest rates all the way back since the 90s, and they can't raise them anymore because if they do, then asset prices are going to absolutely collapse. So when you have a really low interest rate, all asset prices go up because it's the net present value, right? So the net present value of anything is looking at the future stream. It's like accounting 101. But the end result is that every time you pull interest rates down, you automatically raise the price of every financial asset in the economy. And then, the boomers pat themselves on the back at, how wise they were at investing. Now, that was all interest rates. So we're not nearly as bad as Japan is now. Japan is kind of the canary in the coal mine. Japan's in bad shape. They've got inflation is running about 3.7%, which is too high. And they really can't move rates because they've been stuck there for so long. But we are metastasizing into Japan because of this sort of knee-jerk reaction to interest rates. Now, the Fed is funny at the moment. Normally at this stage of the cycle, right, you've got 1.2% inflation, which is lower than the Fed's target. You've got this trade war, which is playing havoc with markets. And normally the Fed steps in and fixes every bit of drama that comes out of Washington. We saw that during COVID, right? So we had the lockdowns and the Fed said, yes, sir, I'll fix it all. They essentially financed, what was it, about $3 trillion of additional government spending, which went to paying people to sit on the couch. And that was why lockdowns polled so well, is because you were being paid. The average American was being paid to sit on the couch, which is a lot more fun than going to work. That was all courtesy of the Fed. So the Fed's got a 100-year record of bailing out every government policy, but they're not doing that on the trade war, even though inflation is actually now half of their target. So it's a funny spot for the Fed now. Usually they would have cut rates by now, and Trump's been going off on that, of course. And people speculate, is it because Jerome Powell hates Trump? Are they trying to effectively dictate tariff policy to make tariffs impossible for Trump? But anyway, that's where we are on the market right now, is that the Fed, currently rates are relatively high. They're high historically. They're actually neutral in terms of, if you sort of zoom out through history, like there's interest rate records going back to 800, the year 800, and current rates are actually completely neutral. They're about 3% real. The reason why 3% real is neutral is that that's the sort of human interest rate. Because remember, interest rate is not the price of money. That's a misunderstanding. Interest rate is the price of time. The price of money is purchasing power. How many logs or how many BMWs can you get with $1? That's the price of money. The price of time is an interest rate. And that's built in to humanity. Sometimes it goes up during war, but generally it's about 3% plus inflation. So rates are actually neutral now. It's an interesting question why they don't cut them. What I think, probably in terms of who's paying in the biggest corner right now is probably housing itself, right? So the Fed yo-yo on interest rates, and you're going to know this very well, but buyers are stuck, right? They're locked into 2.7% mortgages. They're enjoying those mortgages, but the thing is that
Sellers.
Yeah, exactly. So they're enjoying those mortgages, but if they sell the house, now they have to flip over to a 7% mortgage. If they flip like for like at the same price point, that's going to triple their mortgage. Very few of them can afford that. Very few of them can qualify for that. So the Fed yo-yos has done a number on that. You probably saw the Redfin data just from a couple of days ago. There's 500,000 excess sellers now in the market. If we look at what happened last time that was the case, that was about 2014 to 2016. There was a similar surplus of buyers. back then, house prices didn't go down. They did slow to a crawl. I think they moved about 1% per year during that period. But having said, it's hard to say how that compares to today, because back then, houses were recovering out of the 2008 crash. So they were doing 10 or 15% annual before that seller surplus emerged. And then once the surplus came in, they dropped by 80 or 90% in terms of growth. So they didn't actually decline back then, but we don't know how much of that was kind of leftover rebound from the 2008 crisis. So when we take that to today now, I think house prices nationwide are down probably about 5% over the past year, which is not catastrophic. But that was with a surplus of buyers. And so at this point, now that we've got a surplus of sellers, we could see a crash in home prices. The Fed could theoretically fix that pretty easily by just cutting interest rates. But, the Fed's got a lot of other moving parts there. They've got whatever they're trying to do with trade. They've also got, interest expense on the national debt. So there's a lot more sort of considerations coming in for the Fed than the housing market. But as you know, the housing market is such a huge market. It has so much influence on GDP, as well as, being 2/3 of Americans' life savings, that if we do get chaos in the housing markets, I'd be surprised the Fed didn't sort of drop everything and pay attention to that.
Yeah. Just to drop back a little bit, you had, and I hear what you're saying about since Trump, the inflation has cooled, but what we're really talking about is disinflation, right? I mean, it's the inflation from year over year. We're still not dealing with the fact that inflation skyrocketed in the first place and the costs have gone up pretty much across the board.
Right. You will never get that back. The Fed will never allow that to happen. Central banks are built to never, ever allow deflation. So, no, that's gone for good. The only way to get rid of that, Trump can't do it. Nobody can do it. Because the Fed will outbid him, right? The Fed literally has an unlimited money printer. They can do anything they want. So even if Trump tries to literally bring down prices, deflation, the Fed will stop it. So, yep, that's never coming back until we get rid of the Fed.
Until we get rid of the Fed.
Yeah.
Right. Do you ever see that happening?
Andrew Jackson did it in 1930 or 1832 rather. He did it, but the trick is that Americans back then were a lot smarter because we didn't have public schools. The average American learned how to read and write at home, reading the Bible. They were a lot smarter. And we know this actually, by the way. I did a study. I looked at, there's something called the Flesch-Kincaid score, okay, where you can run like a news article through this thing and it'll tell you what grade level is it at. All right. And so every year we have a State of the Union address and we have the inaugural addresses when the president comes in. And these are interesting because they're aimed at the median voter, right? That, like, you're not trying to sound smart in the State of the Union. You're trying to appeal. It's a marketing document. You're trying to appeal to voters. And so you can measure the Flesch-Kincaid on those and then get an estimate of how smart the American people are. And if you look at the speeches from 1900, which is before public schooling started, okay, you had very, very, very small programs in Massachusetts or something. Back in 1900, the grade level was Ph.D. level. Okay, it was like grade 17 or it was just off the charts. In modern terms, Ph.D. level. That was the median American. And then you track through time. As public schools go up, the speeches decline. I think by the time Trump comes in, it was something like 8th grade. And then Biden was something like 4th grade. By the way, Obama was 7th grade. Okay, he was worse than Trump for all, the grief Trump catches and how brilliant Professor Obama was. It's been catastrophic. So, 1832, yes, Andrew Jackson got rid of it, but that's because American voters understood that the central bank was causing the boom-bust cycle. So you had this panic back, I think it was 1827 or something. People were pissed off. They said, we got to get rid of the bank. Look at what it's doing to the economy. And so they did. And, of course, they fought Jackson. In fact, Donald Trump has the bust of Andrew Jackson with him in the Oval Office because he looks up to him. But the difference, unfortunately, between today and 1832 is the education levels are rough. There was a recent survey, I think something like 92% of Americans said they don't really know what the Fed does. So you're not going to get rid of it if 92% of people don't even know what it is.
Well, Peter, I have to tell you, I have to take you back to what you said originally. You said you weren't religious, but I just found a little belief in you. You said that they read the Bible and they were smarter. So,
I have
I mean,
I have deep respect for religion. I wish I were religious because religion makes you much, much happier. So, yeah.
so you think that, and I was going to ask you because I know you had said that the Fed is more afraid of a recession than they are inflation, and you described that. I couldn't have described it better when you said that there's no way we're going to see deflation because the Fed won't allow it, and I think we're all getting to see that. One of the things that has been holding up I guess, our housing market, because I think everybody's surprised. Like, I can't believe that houses are priced at the 2 and 3 handles of 2022 when that sort of bottomed out in the spring and March when the Federal Reserve started raising rates again.
Mm-hmm.
Then we watched over the course of the next year or so, of course, mortgage rates just skyrocketed, but we didn't see that pressure on the home prices, and a lot of that was because of supply issues. And I guess we did see where the age of the buyer went much higher,
Yeah.
and we watched the wealthy jump into the instead of millennials being the major buyer, it was the repeat home buyers that were downsizing from and moving domestically, and that sort of gobbled up a lot of that inventory. But what do you see now? You had said that, and maybe I didn't catch this right, but you sort of indicated you thought that home prices would decline. Because do you see where there's going to be any break otherwise? I mean, what would, other than, and we'll talk about the jobs and salaries. I know I've heard you say that you think that people are making more money today, but the amount of money that they would need to make to afford the home prices of today is a lot more than what I believe we'll see happen. Do you think that regardless of what the Fed does, even when you say, I mean, in 2007, the Fed dropped the Fed rate to about 1%. We then watched the housing market continue to fall and crash. Now, I know there was a lot different circumstances then with mortgage collapse, but we've done a good job of preventing that as far as government stepping in, preventing mortgages. We may have already seen a 2008 crisis if it hadn't been for the remods and the bailouts and things like that of their mortgage payments. Is there a point where you think this will come to a head to where we will see a 2008 type housing crisis? Or do you think the Fed will drop rates and home prices just continue to soar?
Yeah, I think, if we go back to 2014, which I think is the best comparable, I don't know that house prices are even going to decline necessarily. I think that I'd be very surprised if they continue going up like they had, before this past year. 2014, it definitely took the wind out of the sails, but they did not actually decline. A lot of the other economic numbers right now, things like M2 growth, which goes into inflation, those things actually look very, very similar to 2014. So I'm not sure that they're going to come down. But right, you would expect that when the Fed's eventually going to cut interest rates, that's their instinct. It's in their blood. That's what they want to do. That's what they're paid for. That's why Wall Street bribed them into existence. They are going to cut rates, and when they do, that will support. Well, okay, it will support home prices automatically in that sort of net present value sense. But what it'll also do is that it'll unstick all of those frozen sellers. And so, we don't have a direct, or at least I don't know a direct comparable where we could kind of measure how all those things line up against each other. But, on the way up, right, when the Fed hiked rates a couple of years ago, that was actually the fastest pace of rate hikes since the 1970s. It was a pretty big deal. And the surprise there was that it did not hit housing because it froze all the sellers. But now, if we're coming the other direction, then it's possible that we're going to see the exact same thing. So, the mirror image of that being that markets may expect that when the Fed does eventually cut rates, that's going to support housing, but actually it could have the opposite because now it unsticks all those sellers. So I really don't know. Like on my videos, I've been reluctant to make predictions for home prices because of those reasons. There are these two really huge factors that are working against each other where I don't know of any comparables. I don't know the 1970s enough. I suspect that there were probably some similar dynamics happening there. You may know that period better than I. But, I think when you
We had
boil them
double
out.
interest.
Sorry?
We had double-digit interest rates for mortgages. I mean, that peaked out at about 18%,
Yeah.
but we were a lot different back then. We didn't have the consumer debt crisis that we have now. A lot of it was single-income households, a lot of them.
Yep.
I mean, we still had mom at home, raising the kids, doing being a stay-at-home mom. And right now, we're in a completely different scenario where I see it every day. I mean, home buyers don't have $5,000 in their bank account. They want to buy a house,
Yeah.
and they can buy a house with 3% down. Where if you go back even around shortly after World War II, I mean, you needed a lot of money. I mean, you would need 50%, 60% down to buy a house, and they were interest-only loans. And of course, the defaults were, high, and people were losing their houses, and that's why, we had the Federal Housing Administration created and to extend these loans and make 20, 25-year mortgages. But we've just gotten to a point where these borrowers don't have any skin in the game. They're automatically upside down because on average it takes about 10% of equity to sell a house and walk away flush, without owing anything on your mortgage, because people don't put a lot of money down.
Right.
And of course, you have VA at 0% down. There's a funding fee. But I see where we have two incomes in most situations with the buyer, whether they're partners or couple, married or not. But two buyers, we see friends going in together and buying houses. Now there's fractional ownership. It's crazy. But yet, people can't afford to put a roof on their house.
Right.
If it all of a sudden, they over the last 4 years, they bought with no, very few of them had home inspections, or they didn't get their offer accepted. So now we're looking at insurance companies saying, hey, you need to replace your roof or we're going to cancel your insurance. That'll put them in default of their mortgage,
Right.
because they don't have a mortgage insurance provider to guarantee the bank that their money will still be there should something happen to the house. I'm watching all of these things, sort of mound up, and I'm seeing like a disaster coming. I from somebody in this business, I don't see where, with housing related costs and the even dropping interest rates, I don't see how they can't come down.
Yeah, and if we sort of decompose the 2008 crisis, I think that you had three big factors going in there. One of them was, as you say, a lot of people who didn't have skin in the game. Another was the variable rate mortgages, right? And then a third was banks lending to people who they really shouldn't have lent to, right? That was the liar loans. And the skin in the game is arguably worse at this point. The huge jump up in home equity during COVID has probably insulated a lot of that. But as you say, there are a lot of people, especially recent buyers. When we talk about the rising age of house buyers, probably a lot of what's happening there is empty nesters would normally have sold their house and bought the condo. What they're doing instead is keeping the house and buying the condo, and then they're renting the house out because they figure that the rent is covering the house costs. So those people, they're going to have a lot of equity in that original house, but that's also not the right house for them, right? There's a mismatch. They themselves are living in the condo. So they're going to, work hard to keep the condo, even if the condo goes underwater, because that's the actual life that they're leading now. That's where they're, whatever their friends are, their church, whatever it is. So that could get complicated where, the part of their real estate portfolio that has equity is actually the one they're selling. And then the other part, they have no skin in the game. The lending to people who, have bad credit, that got a lot better after 2008 because government said that it was not going to bail them out. fundamentally, when we talk about bank regulators, the key game there is that banks want to get away with as much as possible because they know that taxpayers are going to bail them out. And so regulators kind of fight back and forth. Russ Roberts had a nice image on this. You've got a guy who goes to the casino and he knows that anytime he loses a hand, he's going to get, you're going to come in and cover it. This is the banks. And so in 2008, a lot of people got upset about that. That was the Tea Party, Occupy Wall Street. It was bipartisan. Both left and right were pissed off about the bank bailouts. And so they did make some changes to that. Some of it in legislation, some of it from regulators. So I think that the sort of liar loan problem is reduced, maybe reduced too much because, it's very, very hard to get qualified for a loan now if you're just walking in off the street. There's a flip side to it, however, which is that during the pandemic, the stimulus packages artificially raised credit scores. Okay, so you had a bunch of people who suddenly, who like have never saved a dollar in their life. They're terrible credit, but all of a sudden they got handed these fat checks, and even a lot of those people just paid off credit cards. And so that juiced their credit numbers. And so I think that that's one of the slow motion sort of train wrecks that we're not really discussing is that how many houses how many cars were lent out based on those artificial scores. So I think that we've got some of that liar loan maybe coming out of that, but it's certainly much reduced from 2008. And then the big improvement versus 2008 is variable rate loans. So that, but I can't remember the exact numbers, but they were a substantial percentage of loans back in 2008. Now I think they're like 5%. Basically, nobody gets a variable rate loan anymore. You could argue that, it's appropriate for some people. But anyway, in terms of a 2008 crisis, those are probably, there's probably less risk to that than there was in 2008.
As we wrap up here, Peter, and I'd love to have you back on the, show and kind of play this thing out and see how, the economy's doing. I mean, obviously, it sounds like you're pretty satisfied with what you're seeing the Trump administration do right now. Is there anything that...
Spending is the big problem, but yeah.
Say that again?
Spending is the big problem so far. They're just...
Yeah.
And, a lot of that is Republicans in Congress. They're rhinos. They're useless.
Yeah. So do you have any sort of worries? I know you're saying that the interest or the inflation rate is down. Yes, the spending, the bill, there's a lot of controversy on that. That could be a whole nother show, the big and beautiful bill. Elon Musk said you can have big or you can have beautiful, but you can't have both. I heard him say in one of his interviews, but without, diving into that, is there anything that worries you? Is there anything that you would not be doing right now if you were buying a house or consumer taking on more debt? I mean, any concerns?
I think the sort of biggest economic driver in the next couple of years is going to be government debt. And that's out of control everywhere. It had been growing kind of out of control back during W and Obama, but COVID just really ramped it up to a new level. We have never run deficits remotely close to where we are now in peacetime, and we're in relative peacetime for America. It's about 7% of GDP, which is absolutely out of control. That's IMF territory. It's Argentina territory. That could cause some kind of financial crisis. I think that is a distinct possibility. There's a lot of people warning about that right now. In terms of housing or assets, I think that it actually reinforces them, right? Because if government debt is spinning out of control, then in a sort of natural economy, you would get deflation, but the Fed being the Fed, you're actually getting inflation out of that. They're going to use that as an excuse to ramp up the money printing. And so I think that that's actually going to be very good for nominal house prices, which, assuming you have a mortgage, that's just pure profit, right? If you get 10%, like during Biden, the size of the average mortgage in America collapsed by 20%, right? So that would be, gosh, I don't know, maybe $100,000 in free money that people got because inflation was so high, but your mortgage, the vast majority of mortgages are nominal. And so I think in terms of housing, I think it's actually a relatively safe place to be. I like gold and Bitcoin because those are, they're essentially contrarian plays, saying that government will not get its house in order. I think that, beyond the impact of the big, beautiful bill is what it says about Washington, where, this bill is sort of queuing up $3 trillion deficits, annual deficits over the next decade. The thing is, it came from Republicans, right? That's the kind of thing you expect Democrats to do. And Democrats would do worse. They would do 4 if they had a half a chance. What that's basically saying, if Republicans are delivering a $3 trillion bill, even with Elon, even with Trump, whose instincts are to cut spending, in his first term, every budget pre-COVID, he tried to make huge cuts, and Congress said no every time. So Trump is by instinct a small government guy. He's a Reagan guy. Elon, of course, is a force of nature. So even with that dream team and full Republican control, if we got $3 trillion deficits out of that, we are out of control. There is nobody flying the plane.
Yeah. Well, Peter, thank you so much for being on the show. Like I said, hopefully we can get you back. There's a whole lot to talk on. You mentioned Bitcoin. I'd like to get you back just to talk about that and stable coins. So we hope to see you soon.
Absolutely. Thanks for having me on, Todd.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.